Whether you're an avid property investor or about to buy your first property, why do it alone when you could partner with Australia's best buyer's agent, Director of Pure Property Investment, Property Investment Professionals of Australia board member, and REB Buyer's Agent of the Year, Paul Glossop, can take your portfolio to the next level. Get in touch today to discuss your investment goals. Get one-on-one insight from Paul Glossop. And for the first 100 people, this service is completely free. Head to purepropertyinvestment.com today to schedule your consult with Paul Glossop directly.
Welcome to the Smart Property Investment Show with your host, Phil Tarrant.
Okay, thanks for joining us on the Smart Property Investment Show, where we tell investor stories from right across the nation. And this whole COVID thing has made us think a little bit differently about how we can actually speak to people using the power of the internet. And we're now dialing in people from Port Hedland to Perth to Northern Territory to Tasmania and right across the eastern seaboard now. So we tell those stories. So if you want to come on and have a chat with us, we can do it over the web. You contact the team, editor at smartpropertyinvestment.com.au. Come and tell us your story, whether you've got one property, 10 properties, 1,000 properties. We like to tell those investor stories. It's always been the backbone of Smart Property Investment, and it will be into the future. But today we are back into our physical studio. Social distancing as required. We've got a couple of meters between everyone, and we're all loaded up with sanitisation and Glen 20 and everything else, which is best practice in this environment. So your colleagues here at Smart Property Investment are right across this. But we do like to do these podcasts in person. You typically find it's just a little bit more energy in them. It's a little bit easier to conduct those conversations or get into deep dive type stuff. So today we're going to be doing that. I have in the studio Bobby Haeri. I got that right, Bobby?
Perfect, yeah.
Look at that. I was trying to channel my inner Persian there. I actually phonetically wrote it down here to make sure I didn't get it wrong. But Bobby's in the studio. He's a property investor. We're going to have a chat about his journey investing in property, which has been for over a 10-year period, how he sees the world, what his thoughts are around COVID, and what he's doing right now to make sure that he's been the best investor he can. Bobby, how you going, mate?
Good, mate. And yourself?
I'm okay. So you've come in today from the northern beaches.
From North Narrabeen.
Narrabeen.
I wasn't going to miss the opportunity. I had a choice to do it via Zoom or come in person, and I thought I'd come in person.
That's good. We're pretty distant here. It might not sound it over the airwaves, but we're pretty distant within the studio, and we'll keep doing that moving forward. So if you'd actually want to come and have a chat with us in the studio, it's all cool. It's all safe, and we're very conscious about hygiene in this setting. But you're a property investor, Bobby.
I am, yes.
Why are you a property investor?
Financial freedom.
Okay.
So financial freedom to everyone is different. To me, it's being able to work because I want to, not because I have to. It's being able to travel 3-4 months of the year if I want to.
Which you can't do now.
Which I can't do now, unfortunately. And I'm not going to lie, I like the finer things in life as well. So, I don't think there's anything wrong with that. But yeah, that's why I got into property investing.
That's cool. And we'll have a breakdown of your story. Just to give it at the front end, how many properties in your portfolio now?
5. 5. I've sold 2.
Okay. All right. So was 7, now 5. Okay.
Yeah.
So it's cool. So you're not new to property investing. You've been at it for a decade. It's a reasonably sized portfolio. So just to give me some sense of how we can sort of navigate this conversation, not your first investment. So that would be a different conversation. But let's sort of fast forward, 10 years now and then 20 years from now. Well, tell me about the 50-year-old Bobby. What's he going to look like? What's he going to sound like? What's he going to be doing?
Well, hopefully I've aged as gracefully as you.
Oh, take it easy.
And mate, like I said, I'd love to be traveling 3-4 months of the year. Mate, at 50, if I've got a holiday house somewhere in Mykonos or in Spain or something, that would be amazing. But in the meantime, I'd love to just to be able to travel regularly. When I'm 40, mate, again, working because I want to. I don't want to be acquiring any more properties after 40. I would like to have acquired them all by 40. And then after that, just let time do its thing, even if I can acquire what I want by 35 and just let time do its thing. And yeah.
That's cool. So say on that basis, you've got 5 years to set your portfolio where it needs to be in terms of the assets that are within it. And then hopefully market conditions and time does what it does. And it's a really good point you make, Bobby, because you just got to go through history, and everyone's talking about property prices now and the potential for market drops and stuff. Yeah, property goes up and down, always has done. But if you go back 200 years to where we are today, property's always been a good performer. So, time is a very important part of any property investment portfolio, and time is your friend. And the longer you are in the market, the better off you will do out of it. So, with a strategy to stop buying at 35, which I challenge you, it's probably not going to happen, but it's nice to think about right now. But, as a hypothetical, to stop buying at 35 and then letting markets, and you know, they talk about whether or not you subscribe to these numbers that, you know, properties value every, was it 7 to 10 or 7 to 12 years, whatever that is, right? Like, you know, sitting neither here nor there, but if you buy correctly, it goes up. So hopefully the properties in your portfolio are the right ones. And mate, let's break them down. So when did you start investing? Which year was it?
So I bought my first property in 2010.
Okay. Which is 10 years ago.
Which is 10 years.
And whereabouts was it?
In St Ives.
Okay. And where's St Ives for those that don't know?
Sydney's North Shore.
Okay.
Sydney's North Shore. It was a 2-bedroom. It was the what not to do with every single investment property. And I did it. Meriton.
Yeah. Good brand, Meriton, by the way.
Yeah, also, I mean, off the plan. I shouldn't say Meriton.
Yeah.
I should say off the plan. It had the swimming pool, the sauna, the high stratas, everything not to do, I did. Thankfully, it was at the bottom of the market, so I got good results from it, but that was pure luck.
So is this on the main drag there through Motorvale Road, through St Ives?
Just off the main drag. Do you know Memorial?
Yep.
Memorial Avenue?
Yeah. Oh, I think I know the block.
Yeah. It was one of the first ones there.
Yeah.
One of the first blocks.
So how much you pay for it?
$575.
Okay. And do you still have it?
That was one of the ones we sold last year.
How much you sell it for?
We sold it for $800.
Okay. So what sort of debt were you carrying on it during that period of time?
We hadn't dropped much debt because my sister tapped. So I bought that with my sister.
Okay.
She tapped back into it to pull some money out to start a gym.
Okay.
And then we also used the equity to purchase our next property as well. Okay. So I think there was probably about 530
on it.
Yeah, on it when we sold.
Okay.
So there wasn't that much. But
and
yeah,
you sold for 800.
Yeah.
So okay. So you're happy with the result?
Happy with the result because I'm going to make that money work better for me elsewhere. And I guess just to say, the reason why I sold that, well, we sold that was because it was mine and my sister's apartment. However, it was only under my sister's name. At that age, I wasn't in a position to get on the loan. So she got the loan, but we both paid the mortgage.
Yep.
And essentially, I couldn't tap back into the equity because it wasn't in my name. And she's not as much of an avid investor as I am. So we agreed, let's sell. She's with her husband now, using that money to bring down the interest, and I'm using that money elsewhere.
Okay. And you sort of 50-50 right the way through it? So when you sold it, you split the proceeds 50-50?
More towards me because she took some money out for the gym.
Okay.
And also I was making extra payments.
Okay. So, but you worked all that out. It's pretty easy to do. It's just numbers on a spreadsheet and stuff.
Exactly.
So essentially it's just a utility vehicle to get you guys investing in property, and you've exited out of it. It sounds like it's been reasonably clean, right?
Yeah, 100%. Like I said, it was quite lucky that it was at the bottom of the market. We saw some good results there.
So why did you buy off the plan to start with?
I think at that time the government was giving stimulus packages for buying off the plan.
Yeah.
First home buyers off the plan. I think you're saving about $30,000 or $40,000.
True.
And at that age, the new shiny stuff looks like the best stuff. So we didn't have experience, so we just went into, what the government incentives were, and also at that age, like without the experience, we thought the newer the product, the better it is.
Yeah, and there's always a discussion. It depends where you sit in property on whether or not you should buy off the plan. There's a whole bunch of people that would say, yes, buying off the plan is the best way to buy, and here's all the reasons why, where there's a whole bunch of people that says never buy off the plan, and here's all the reasons why. And it's horses for courses. It's a strategy that works for some people. If you commit to a purchase at the bottom of the market, and then when you get the keys for the purchase and the market's gone up, it's good to buy off the plan.
100%.
I know. But if it's the other way around, it's bad to buy off the plan.
100%. I think that's why I said it was pure luck that we did it at the boutom. You hear the horror stories about how people do it at the top, and it ends up a nightmare.
Yeah. I know some people who've absolutely killed it buying off the plan. They've just timed it right, bought the right type of stock. I think the biggest challenges you see when people are buying off the plan is when markets shift like they have done most recently. And when you see these huge density projects, and I would think of places like Alexandria or Green Park and stuff out there sort of running out to the airport, where there is literally thousands of everything which is exactly the same.
100%.
This is when you start getting in the challenges. So if you're going to go down the off the plan path, get lucky like Bobby did, or be really smart about how you buy. And it's a lot of information. We write about it on smartpropertyinvestment.com.au quite a lot, so go and check it out. But this is sort of a stepping stone again. What sort of work were you doing way back then, 10 years ago when you were 20?
No, at 20 I probably would have been a labourer.
Okay.
I would have been doing maybe office removals, or I was with a recruitment company, so they would have given me some office removals job. They would have given me labouring job. So it was just random work.
Just random work.
Yeah, we were living with our parents, so we didn't really We didn't need regular income. It was just random work. But then when you got that asset, you got a bit more responsibility.
Yeah. And you never had any problems with any commitments paying down the debt and the mortgage and stuff?
No, I never had any problems.
Getting looked after by mum, no doubt, getting good food and
exactly.
stuff. Yeah.
Not paying rent at home and getting good food.
Did it compromise lifestyle, like the commitment you had to pay down a debt? Did you stop going out and doing what you do when you're 20?
100%. And that's half the reason why we did it, because we were wasting a lot of money. So let me backtrack, right? So with that one, with the St. Ives property, my dad, when we were living there, we were working, and he said, you either got to move out and start paying your own rent, or you got to start paying me rent, or mum and dad were going to fork out the deposit and we pay off the mortgage. So he saw that we were wasting quite a bit of money, and he said, look, these are your three options. And we obviously took the latter option.
That's actually pretty smart on behalf of your parents to do that, right?
Yeah, 100%.
Just to give you some focus and discipline, right?
100%.
So they said, we're happy to underwrite your living expenses living at home with a bedroom and food and all that sort of stuff. Just don't blow your money just being idiots.
Yeah, exactly.
Yeah.
And if you do want to do that, then go out and live on your own, because living on your own, then you're forced to watch what you're spending and being idiots. Yeah.
Yeah. So how long did you live at home before you moved out?
I think I lived at home till I was about 23.
Okay.
Yeah.
Then went and did
Went
whatever.
with the girlfriend who's now fiancée and wife.
Okay. Oh,
Yeah.
congratulations.
Thank you very much.
Yeah, no, it's well, yeah, you're down the pathway there, which is really good. So do your parents property investors? Have they got a property bent?
Dad loves property, so I think he's the reason why I got into property. He doesn't have a portfolio. It was a bit harder for him, I guess, migrating here 30 years ago. He was an accountant and finished his master's here, but really struggled to get work. So he was bus driver, taxi driver. So he was quite hard for him to, I guess, build wealth, but he had the headspace and taught me, I guess, what should be done.
Where's the family from?
Iran.
Yeah. Oh, okay. And you moved out here sort of 30 years ago?
Yeah, we moved to Wollongong first.
Okay.
And then from Wollongong moved to Chatswood, and then after Chatswood we've been on the beaches, North Shore and Northern Beaches.
Well, knowing my Middle East politics and 30 years ago, I probably understand why you probably left Iran. But
Exactly, that's right.
It's a big Iranian community here in Sydney, though, isn't there?
There is, in the hills. Well, I think we're quite widespread now.
Yeah. Are you still connected in with Iran, that sort of whole community and stuff?
Not as much as I probably should be, no.
Are your parents, though? Do you speak Farsi at home?
Yeah, I speak fluent Farsi. My parents actually have a Persian grocery store.
Okay.
So they're in the Persian community. But myself, no, not really.
Yeah, I'm always intrigued, and I sort of have these chats a lot when people come, and we're very fortunate in Australia. We have such a vibrant makeup of the people that live here, but every single culture has a different attitude to wealth and a different attitude to debt and a different attitude to property and a different attitude to their relationship with property, right? Well, what's the sort of Iranian view to it or the Persian view to it? Do people strive to own property as a measurement of success?
Majority of them, yes. Property, I think they see it as the strongest asset class to reach your wealth creation goals.
Yeah, it's interesting. Well, what about debt? Is debt okay?
Good, there's good debt, bad debt, but it
Yeah.
depends who you speak to. You speak to some people and they're like, I guess like a lot of cultures, you speak to some people, they don't want to get into any debt. Other people, I guess, who have a bit more experience, they're not too concerned about debt. I got taught quite young, there's a difference between good debt and bad debt. And the reality is, if you don't get into bad debt, for the 99% of us, we're not going to get ahead.
Yeah. That's good. Well, it's pretty consistent with, I guess, Western culture, right? Good debt, bad debt, but irrespective of your cultural background, a lot of people still get it wrong, right? And they love the bad debt, not the good debt, right?
Exactly, yeah.
And you mentioned that you like the sort of finer things in life, right? But, property's a vehicle to help transition you into that rather than go into debt for that sort of stuff. That's a different question as well, right?
Exactly. And I'm happy to postpone that stuff and set myself up first so I can have that stuff later.
Yeah. And delayed gratification is key, and is what I see in the best property investors. They're wired that way. Bobby, we're going to go to a break, mate. We'll come back. I want to chat through some of these other properties and what you think about the market. We'll be back in a moment.
Are low interest rates impacting on your investment returns? It's time to rethink. Rethink Investing creates wealth for clients through the strategic purchase of positively geared, high cash flow commercial property. Industrial properties, retail assets, or office spaces can be a smart investment option that produces significant and long-term return on investment. Rethink your investment options and look to commercial property. Learn more at rethinkinvesting.com.au. Rethink Investing, Australia's #1 commercial buyers agency.
Welcome back, everyone. Here with Bobby Haeri, chatting all things property, his property journey. First property, St. Ives, that's big bananas. 575 grand 10 years ago, sold for 800 last year. Most people's first investment property is a little bit on the cheaper side than that, but it's good to see you're ambitious to get going. So where was the second property?
So the second property was just up the road in Killara.
Yep.
Just off, it was on Pacific Highway, so Sydney's North Shore.
Yes.
And that one was a 2-bedroom, red brick, low maintenance. I think it was only 2 stories, 4 units in the block.
So which side of the Pac Highway, if you're going north,
that
left or right?
That bar, that pub right on the main road, the Green
Gate, is it?
I think the Green Gate. It was across the road from there.
Oh, okay.
So if you're going down towards the city, it's on the right side.
On the right side.
Yeah.
Yeah, okay. Green Gate. It's Green Gate Hotel.
I think so, yeah.
Not that I know anything about pubs, but
yeah, so we got
I know the Green Gate. It's a good pub, by the way.
I've never been.
Oh, have you?
Oh, actually, I've been once, yeah.
So red brick, couple of stories, no pool, no gym, no concierge, no huge strata levy, no big body corporate.
All the things you're meant to do with your property, or you're generally meant to do with your investment property, we did on the second one.
Okay. So why the change in focus? When did you buy it? Sorry?
That one was 2 years after St Ives.
Okay. So 2 years in the game as a property investor, learning, changing your views towards stuff. That is complete about face in terms of asset class or asset sort of that you've purchased there.
There was
why?
Why did we change?
Yeah.
The strata levies with the first one.
Okay. So you were just getting sort of,
Yeah, you get hammered a lot with those strata levies. You get hammered a lot, and this one was to be honest, I can't remember how much the comparable sales were at that time, but this one was quite cheap, so we sort of just jumped on it. We weren't planning. We didn't have in our head, let's go for a 2-bedroom. We didn't really have a strategy at that time.
Yeah, you saw it, thought that was good value. Did you do it with your sister again?
With my sister again. Okay. Yeah.
Was that part of the mandate from the parents saying you're doing too good, go and buy somebody else and lock you in?
Yeah, you've got your equity now. Dad was like, you've got your equity here. Now you can just let that sit there and be wasteful. It's not doing any good there. And one property is not going to get you to your end goal.
Yeah.
So you've got that equity. Let's tap into it and go again.
So there's the utility of using your money smartly. So you bought that. So what'd you go for, like an 80% LVR on it, or?
I think so, yeah. I can't remember at this stage, but I think it was.
Okay. And you still have that property?
We sold that one
sold
too.
That. Okay, so that's been sold. When did you sell it?
A year later.
Okay.
Because one in the same block sold about $100,000 or $120,000 over what we had paid. So we just thought, well, based on that, that was when Sydney was really starting to move.
Yeah.
Again, we didn't have a strategy at that time, but we just saw the dollar signs and we're like, look, we can probably make $100,000 in a year on average, so let's sell it.
That's cool.
$100,000 in a year on a $435,000 property is big numbers.
That's great.
So
it would have been probably what you were earning labouring, right? Like 50
more,
grand in your back pocket.
$50,000, yeah, exactly.
Oh, like after tax and all that. So that's a good earn. Making more money as a property investor than LA. But you can't actually invest in property unless you're getting cash flow, right? So you got to work for the cash flow to actually get into a property, get debt, and then try and maximise it, pull money out of it. And this is the cycle that many people can. Do you wish you still had it? I reckon it's probably worth a lot more now.
I'm glad I sold. I mean, one side of me says I shouldn't have sold, but I put that money right into another asset. So what I would have gained there, I've gained elsewhere. And also shortly after that, I was going to propose to my wife and we were going to go on holidays, and there was an expensive time. So I used some of that money on, the rings, the holidays, all that sort of stuff, honeymoon. But then what was left over, I put back into another asset.
How did you work out? I'm married, obviously. How did you work out? Did you get fooled into this metric that is out there around that you've got to pay so much on a ring, which is X number of months salary or something?
Is it 3 years salary? Or 3 months?
I don't know what it is.
Well, thankfully I wasn't making too much money then. So,
mate, you just made $100,000, right? I'd be looking for a pretty big ring, to be fair. But,
how funny.
But anyway, we digress. So that's cool. So you're always thinking in the background how you're using this money, what you need to do with it, these sort of commitments, which, I'd say marriage is probably the best investment you'll ever make. It costs you a lot of money at the front end in terms of like weddings and stuff, but it's a great investment.
100%.
So this is all part of the journey, but this is when you got to balance life with investment, right? Making sure it all works together.
Exactly.
And third property then, where did you go after? So you sold that before you bought anything new. So it was just, there was no interim bit there.
No, exactly.
Okay.
We sold that. We didn't do anything for a few years. Mind you, the St Ives property we didn't sell till only last year. So we did have that St Ives sitting there.
Mate. Yeah.
But we sold Kalara, didn't do anything for a few years. And then in 2015, we bought a 1-bedder in Brookvale, which was a PPOR.
Yep. Okay.
But it was with our budget, we were tossing up at that time between like an entry-level 2-bedder or a nice 1-bedder. So we got one it had a 90-metre square garden, had a nice entertaining area, deck, all that sort of stuff.
Were you married by this point?
No, we got married soon after.
Okay, cool.
Yeah.
So a 1-bedder in Brookvale. Where in Brookvale?
Do you know the Oval, Brookie Oval?
Yes.
Right up the hill.
Okay.
Shackle Avenue.
Yeah, okay.
Yeah, right at the top of that hill.
Okay, and you still own this place?
We still own that place,
so you bought it to live in, and then now it's just an investment property.
Exactly.
Which is what a lot of people do.
Yeah, we bought it to live in. We were there for, I think, about 3 years.
Yep.
And then we just wanted to move a bit closer to the water in a more ideal location. So we rented that one out and have moved to Narrabeen now.
Are you a Seagulls fan? Do you follow them?
I'm not, no.
Okay.
Mind you, I'm starting to like them more because now in Narrabeen, I see the boys like when they were training pretty much every morning. I guess when you see the guys like every few days, I guess you feel like you know them.
Yeah. Where do they run along the beach and stuff, do they?
So I think they train in Narrabeen and they play in Brookvale.
Yeah.
So we just go to the same local cafe.
Okay.
At Ocean Street, yeah.
Sweet. Okay, what was next? So the third property, so Brookvale, one better. And Brookie's an interesting... Brookie, I don't know if I can call that. I'm not that local.
Right?
Can I?
Of course you can.
And for those that aren't really familiar with the area, it's up on the northern beaches, but Brookie's it's a really strange suburb compared to everywhere else in the northern beaches in that it's quite industrial and it's quite gritty suburb, right? It's very different than everything else around it. So you've got a lot of industrial area in there. You've got a lot of apartments in there. It's sort of right along the main drag going in Pittwater Road. So it is quite unique. And you see a lot of investors actually invest in that area. And the next suburb up where you would see that would be someone like DY, right? Like there's sort of very similar type of suburbs, but they're unique on the northern beaches.
Yeah, exactly. And that was a bit of method to our madness. Like the Brookvale prices were a little bit cheaper than DY at that time. And there is potential there for it to gentrify over time. Yeah. So, I mean, down near the mall, the Westfield, there's it's a lot very commercial, but further up, there's apartments. And over time, I think as the population increases, that area will change.
It will fill in, absolutely. I think when you look at some of the suburbs around it, like you've got Balgola to the south, Manly Vale, you're moving up into sort of the DY area, moving up north. And, it is an interesting suburb. And I've looked at properties. I've never bought there, but, you can still get still a lot of 1 and 2 bedders up there. I might go and check it out. I haven't looked at it for quite some time. So how much you pay for it?
We paid $575.
Okay, and today that's got to be worth a few more bucks than that, I would imagine.
Comparables have sold for about $750. So, or even in the peak, it was higher. It was about $770, $780.
Okay.
A few down the road sold for 1 bedroom, sold for $800, but not in DY. They were not in Brookvale, sorry, they were in DY. Yeah. So I reckon about $750 now would be fair to say.
Okay. What sort of rent are you getting on it?
We're getting $650.
That's not bad then.
So the tenants that are in there now, they have 2 dogs. I think one of the owners has, he gets seizures, epilepsy, I think it is. So he has 2 dogs for that, but then they also have another 2. So they got 4 dogs in there.
4 dogs in there.
Which we don't mind.
Yeah.
We were going to change the carpet after they leave anyway because it's getting a bit old and they were paying about $150 more than the normal rent. So
they can have their dogs.
Yeah.
So it's ground floor, is it? So it's got an area out the back and everything, like a big area. That's cool. So if you can get those ground floor flats, like some people are a bit... they don't go, I don't want ground floor because they're not as secure and stuff. But if you actually get access to whether an owned area or most of the body corporate sort of area, that sort of works quite well. And one of the benefits of having flat. And so how many in a block there?
That one, there's 40 units, but there's 3 blocks.
Okay.
So it's a weird shaped one. There's 3 blocks and it's L-shaped down to Victor Road, but each block maybe has about 20 units in there. It's only 2 stories.
Okay.
So no lifts, no swimming pools, nothing like that.
Yeah. There's no strata issues with pets and stuff?
No.
Yeah.
Pets are all good.
Yeah, pets are good.
If I didn't have pets, to be honest, I wouldn't go into a pet-friendly block. But, I mean, if I got pets, it's great.
You got to have pets. I think a home needs pets.
100%.
Anyway. But a lot of, and it's an important point, a lot of property investors are a bit sort of strange around them, going, I don't want someone with pets in there. They might wreck things or scratch the walls and stuff. You know what? A coat of paint ain't that much. But if you get really good tenants in there with pets, they're really normally sticky, really, really sticky, and they'll stay there for a long time. Exactly. They'll pay the rent. It sounds like you get a premium as well.
100%. Yeah, exactly.
Why not?
If they're paying $100, $150 over, that adds up in the year. So if you got to repaint or redo the carpets, which we're going to do anyway, it makes up for it.
Yeah. And you know what? Like, you can connect in and have it sort of noted on the lease. You do have a bond, right, as well. So if there's any deliberate damage or excessive damage as a result of pets, you can claim it on the bond, right?
Exactly.
It's a bit tricky, a bit grey, but that's something that you do have up your sleeve. So if you are a property investor, and you must be if you're listening to this, don't unnecessarily say no to pets in your property. That's my view. It's not my advice at all. But anyway, horse for courses. Bobby, what was the next properties?
After that, we went to Grafton.
Okay.
So we wanted to continue investing. However, we needed a bit of yield.
So Grafton is not in Sydney.
It is not. It is near just in 1 hour inland from Coffs Harbour.
Yeah. And it's probably an hour and be like 2 hours up to the border from there, wouldn't it?
I think so, yeah.
2.5 hours, yeah. Okay. Yeah. Grafton's it's a real agricultural town by memory. It's on the McLaren River.
Exactly.
It's on the McLaren.
Yeah.
Look at that.
You know your geography.
Yeah, I used to do a lot of surf trips up that way. So every now and then we used to have to go in through Grafton, I think. But real agricultural belt up that way. It's struggled a little bit over the last couple of years. How are you gone with the properties up there?
Yeah, good. So Grafton's actually performed really well. So the reason why we went there, I mean, they've got the agriculture there, but they were also, they've built the biggest jail in Australia about half an hour outside of Grafton.
Okay.
Well, I think it is in Grafton actually. And also there's a Grafton bypass. So there's quite a bit of infrastructure going in there. And if you've got 2,000 employees going into a regional town that already has several industries, that's essentially going to change the dynamics over time. So we wanted something with high yields, with good growth potential down the track, and we got that there actually. That's grown.
So you did a subdivision on this, did you?
So we bought one established house.
Okay.
We rented it out, and we've also done a subdivision with 2 other houses there. So we've got 3 properties there at the moment.
You got 3 properties on one block?
No.
So 3 blocks now.
So we've got 1 property in Grafton, and then down the road we've got 2 properties on 2 separate blocks. So we've got 1 block and we split it.
Okay, so there's 3 properties. So you bought one place that's still there, then you bought another block, but you split that in 2.
Exactly. Yeah,
Okay. Okay, so you got 3 properties in Grafton.
That's right.
Okay.
And they're giving about 7% yields.
Yeah, it's pretty good.
And in terms of growth, we bought in 2017 and it's had about 25% growth, Grafton has. So it's grown quite well.
And it's easy to tenant up there? Like no problem with
vacancy rates were rock bottom when we bought.
Yeah.
They've gone up a little bit now, but still when I say go up, they're about 1.5%. So it's going to find its equilibrium, and I think it's a matter of finding the right assets in the right suburbs, right? So even if the vacancy rates go up a little bit, if you've got the right assets, they're going to be the ones that are in demand.
Yeah. But you built 2 properties on that block or
Yeah, 2 separate properties on that block. Father-in-law is a builder.
Your father-in-law was a builder? Okay.
So they went up for 6 months and father-in-law and brother-in-law did the build.
Oh, is that true? Did you get a good price?
I think so. Yeah. No, we did. We've spoken.
They're working around Rolexes now, are they?
No, they did. It was quite difficult for them because they had to deal with local tradies, and it's hard being a builder from out of town.
Yeah.
Going local. So it actually blew out quite a bit.
Okay.
So I think they cut their losses a bit on us.
So So it's just a job for them to go and build 2 properties over 6 months?
Yeah, so my father-in-law wanted to retire and he wanted to move to Tassie, but then my brother-in-law was an engineer and hated that lifestyle, so wanted to become a builder. So it was a great experience for father-in-law to hold off on the retirement, give the experience to my brother-in-law, and they worked together, got the experience, but then now he's gone back to engineering.
Okay, so he's not building anymore?
No.
Did you marry an Aussie girl or a Persian girl?
She's half Chinese, half Aussie.
Okay.
Yeah.
Yeah. So how did you end up in Grafton? Like, did you just go,
the infrastructure that was going in, the numbers just stacked up.
Yeah.
So.
Okay. And are they identical houses?
Yeah. The block that we split is identical.
Yeah.
3 bedroom, 2 bathroom, 1 garage.
They're not joined.
They're not joined.
Okay.
Yeah. So we could sell one right now if we wanted to. But we're renting them both out.
Yeah.
And then the other one is just a standalone house.
Did they build in parallel? They built one and then built the other one?
They built one. And then, so they did the slab together.
Yeah.
But then from there, they did one and then did the other.
Did the other one.
Yeah.
So did you get one finished and rented while the other one was getting built?
No, it wasn't completely finished. So they both got finished at the same time, but they come to think of it, they both finished at the same time. So they were doing the slab on one, then the other, and then they'd do the brickwork on one, then the other. Yeah, and then the roof on one, the other. So yeah.
Okay, so some efficiencies there. And that's sort of, I guess, a bit of diversification for you, right? Like having some regional assets, and it's good to have different properties in different locations. So was that the end of it? You any more properties after that?
Yeah, after that we went to, my last one was last month in
Brisbane.
In southeast Brisbane.
Whereabouts? Which suburb?
In Kingston.
Okay. I got a property in Kingston. It's an absolute nightmare.
Why is that? The tenants?
I reckon I've probably had it for 3 years, and I reckon it's been tenanted for maybe a third of that because it's always a problem.
Really?
Yeah, water this, leaks that, things falling down, this is broken, this doesn't work, this is dangerous. Yeah, it's one property in my portfolio which just go, I wish I never bought that.
That's giving you headaches. How funny.
It's just a nightmare. It's just a money pit,
Do you think it's the build or the tenants, or what do you think?
Nothing to do with the tenants. It's just a crap property, right?
The build.
It was a good buy at the point in time, thinking because we saw what it could be when we got it. But if I had my time again, I'd probably not buy that property just because it's just a nightmare, absolute nightmare. But anyway, so we're in Kingston.
Do you know Yalloomba Street?
I know on a map. I've got properties in Kingston. I've never been there.
Okay.
But I know the road on a map.
Okay.
So, yeah.
Yeah. Also, I guess it's close to the schools, it's close to all the infrastructure, close to the schools, close to the close to everything that I guess is sort of important to tenants. And I guess one of the reasons why I chose that one was it was a low maintenance, red brick tiled. It wasn't one of the old high set ones.
That's what I've got.
Okay.
Yeah.
The old, I guess you can add value with them, but you're going to have headaches in the short term potentially.
The high set's the issue, right? Like, because it's never done properly. They're filled in the bottom of it. It's a bit hodgepodge, you know. And, it's not, you can't sort of rent it out as a 6-bedroom house, right? Because it is only a 3-bedroom house. You can't classify the bottom of it as a, part of it's just storage, right?
Yeah.
So, if I have my time again, the red brick stuff's okay, like single level stuff, but high sets is like, yeah,
this is just low maintenance on a square block. I can do a granny flat down the track, brick tile. The tenant in there has been there for 5 years and she's got a government job that's not moving.
Okay.
So for me, it was like, if I can buy something under market value in this climate, if the tenant's not going anywhere with a safe job, why wouldn't I jump on the opportunity?
Are you expecting good capital growth there?
Probably not in the next 1 or 2 years, but in the long term, yeah. So that was more a play for yield and granny flat potential down the track.
Okay.
And over time, that area is going to gentrify. So
I think it will do over time as it sort of fills in. But interesting. So that's the base portfolio. I want to sort of have a look, Bobby, at what's next for you guys. And you said you want to sort of get your portfolio set by 35. So what happens in the next 5 years? We'll go to a break beforehand. We'll be back in a moment.
Love property? The current Buyer's Agent of the Year and Director of Pure Property Investment, Paul Glossop, does too. And right now, he's offering you the chance to secure his best-selling book, A Surfer's Guide to Property Investing, absolutely free. Simply jump on Pure Property Investment's Facebook page, hit the message button and type Smart Property to claim your free book today.
Welcome back, everyone. Here with Bobby Haeri, chatting his portfolio through. So you've got 5 in the portfolio now because you've sold 2.
Yep.
And you want to keep going. What's next for you? So what's the next 5 years look like to get to this portfolio? How many are going to be in it? What's the value of it?
Okay. So I don't think the number is that important. I think it's more the value. And the next step at this stage, we're getting a pre-approval to go again.
Okay.
My wife is actually pregnant. We're expecting in...
Congratulations.
Thank you very much. Yeah. We're expecting in July, so I'd like to get another one before she takes time off.
Yeah.
And then it just depends on what our borrowing capacity is going to be after that. So we've just got to see where our servicing will be, where our borrowing capacity will be. I did have like a... you know how you set up an end goal and then you reverse engineer a strategy, $100,000 passive income target or whatnot. I did have that goal originally. However, I don't have a passive income target that I want to reach now because I love what I do now for work. So previously I wanted to stop working as fast as I could because I'm quite passionate about not trading my time for money. But if you're enjoying what you do, I mean, it's a cliche, but it doesn't feel like work.
Well, I think for many people, that's a trigger point for when you're retired, right? It's like when you do what you love, it's not really work. So so what's the current valuation for your portfolio?
Oh, good question. Good question. I
wouldn't
be
adding up
able
his
to,
numbers. You don't have a top line. Do you know what sort of LVR are you sitting at?
It's sitting at about 80%.
Okay.
Probably 2.2, 2.3 million.
Okay. At 80%. So you need some capital growth here at some point.
Yeah.
You don't want to start refinancing that.
Going above 80%.
Well, then you sort of cop so many, like money's cheap at the moment, which is not a bad thing. I think once you get up over sort of 90% lens, it's a lot more expensive. You've got LMI, which is neither here nor there. It's enabling in many ways. But so what's this sort of end goal valuation that you're sort of chasing at the moment?
So I was starting with 100,000. It just sounds straightforward, right?
Yeah, as a passive income.
As a passive income, but that's gone now. We really don't, to be honest. We don't have an end target that we're trying to reach. It's just, first of all, not over leveraging ourselves, building the portfolio comfortably. And I don't have a goal to get 100 properties by the time I'm 100 or anything like that. It's just a matter of buying when I can comfortably afford to. And everything I'm going to buy from now is going to have granny flat or subdivision potential.
Yeah.
And I will put the granny flat or subdivide down the track for my exit strategy.
You've got to get your brother-in-law back into it, mate.
Yeah, we're trying to. Exactly, that's right. So for the exit strategy, I do need stuff with granny flat or subdivision potential. That's essentially going to help us pay the mortgages down in 10, 15 years as opposed to 30.
Yeah.
But it's just when we can comfortably afford to. So with this next purchase, we're not going to tap into any equity there. We don't want to go over 80%. We're just going to use cash deposit.
It's good. And what sort of assets then, what area are you going to be looking for? That sort of Brizzy area, is that what you're targeting?
No, I'll probably go the next one in Adelaide.
Okay.
Yeah, in Adelaide, a few different pockets there that we're looking at. Where we go really depends on how much we can borrow.
Yeah. Interesting. Well, keep at it, mate. So what's your thoughts? Is this sort of COVID-19 thing changed your mindset at all about what you're doing, how you're doing it?
I know it's still early days, but it's actually given me more confidence in the property market. So we haven't seen it drop yet, but it will undoubtedly. I mean, Northern Beaches has actually dropped about 5-10% in like a month.
Northern Beaches is always a bit up and down. it's a lot more compared to like maybe other areas of Sydney, which are a little bit more stable. When Northern Beaches will go up, it'll go down more than any other area, right?
100%.
It's just the nature of that market up there.
Yeah, that's right. So I mean, the current climate hasn't really changed my mindset. I'm not buying for the next 1 or 2 years. I'm buying for what's going to be happening in my retirement in 20 years or whatever. Yeah. So what happens now doesn't really matter. If I can snap up a property 10% under market value, then I think it's a great buy, because I know in 5 years' time, when the government starts spending all the money on infrastructure and they start increasing migration and all those triggers they pull historically, when they start doing all that, we can expect sort of prices to start skyrocketing again. Yeah. Well, I shouldn't say skyrocketing, but we can start expecting prices to start moving quite quickly again.
Getting back into the normal rhythm of property markets in Australia is that property market should be increasing over time, right? Back to our earlier point. But there's going to be peaks and troughs in that. And the best investors I know are buying the right properties at the right point of cycles. And that really is the art form of investing in property. Mate, Bobby, I've really enjoyed the chat, mate. It's good. It's a good little portfolio you got there, and definitely on your way to realising what you want to realise. So you, by and large, you're not worried at all about property as an asset class. You're just going to continue to buy well, buy in the right place, buy for the future. Yeah, pretty much. I mean, like, even if you look at the past 4 downturns, 4 recessions, 2 of them property prices didn't drop. The other 2, they dropped by 5 or 6%, but then the year after they went up by 10+%. Yeah. So this time is a little bit different. However, like, the numbers still, like, the fundamentals are still there. So if we look at interest rates are still record lows, and they're not going to be moving anytime soon. And then in addition to that, you've got APRA, who eased their lending, and we saw what happened when APRA eased their lending after the Royal Commission and interest rates dropped. We were seeing double-digit growth, right? So those fundamentals are still there. The demand is still outweighing supply in the capital cities and established properties. So that's the third fundamental that's still there. The only concern that I guess is there is unemployment. Yeah. So unemployment is, it was at 5%. They're predicting it to go to 10%. But I guess what the government's doing to counteract that is they're going to try put the economy on hold for 6 months. After that, it's going to be infrastructure spend. After that, it's going to be increased population, allow everyone back into the country. So they've got levers they can pull, which is going to dry up that unemployment. Whether it happens in 6 months, 12 months, or 18 months, nobody knows. But when that unemployment does dry up again, that's when you got all 4 fundamentals lined up. You're going to see some really strong growth. Let's get you back in, Bobby, and have a chat about that moving forward, and when you buy your next stuff as well. I think sounds good. I think I'd enjoy that chat. So will our listeners. But thanks for coming in today, mate. Hey, thank you for having me. It's been a pleasure. Nice one. Remember to check out smartpropertyinvestment.com.au. If you're not yet subscribing to our daily morning newsletter, so you're the first to know what's happening in property investment right across the nation, particularly at a time of market flux of COVID-19, smartpropertyinvestment.com.au/subscribe. Social media, Smart Property HQ. Remember, we want to do a lot more of these investor stories, so come and have a chat with us. We're at that point in our cycle now where we've deep dived into speaking with all the experts about what they think about stuff. Now we want to start getting the investors in to give their narrative around it. So get in touch with the team, editor at smartpropertyinvestment.com.au. And please, if you like what we're doing with this podcast, leave a review, 5 stars. If that's what you think we're worth, I say we are, but wherever you listen to this, the team get a real kick out of it here. It's more than just me here behind the microphone. There's a great backbone of producers and other people here who make this happen. We'll be back again next time. Until then, bye-bye. The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.
Are low interest rates impacting on your investment returns? It's time to rethink. Rethink Investing creates wealth for clients through the strategic purchase of positively geared, high cash flow commercial property. Industrial properties, retail assets, or office spaces can be a smart investment option that produces significant and long-term return on investment. Rethink your investment options and look to commercial property. Learn more at rethinkinvesting.com.au. Rethink Investing, Australia's #1 commercial buyers agency.